Look at the numbers on your screen right now. If you feel like your stomach is on a roller coaster, you aren't alone. In the last 48 hours, silver has done something we haven't seen in over 40 years. It didn't just move, it teleported. We saw a crash from the mountaintop of $121 all the way down to a scary floor between $71 and $78. Billions of dollars were moved from one hand to another in just a few heartbeats. But then something strange happened. While everyone on the news was screaming that silver was dead, the price started to jump back up. It bounced 6% higher in a single session. This is what we call extreme volatility. Most people look at these lines and see chaos. I look at these lines and see a math problem that is currently being solved. By the end of this briefing, you will understand the oversold math that the big banks don't want you to see. You will know why a fifth grader can understand this chart better than most Wall Street experts who are currently panicking. This is day 2 of the historic correction, and the paper noise is louder than ever. It's time to look at the atoms. The first thing you need to do to prove you are part of the core and not just a bot following the crowd is this. Comment "Wealth on Wired" and the exact price you see for silver right now. Let's see how fast the paper price is changing while we speak. The algorithm hates this kind of real-time tracking. Let's show them we are awake. Let's look at the first piece of evidence, the big drop. On Friday and through Monday, February 2, 2026, silver suffered its biggest multi-day drop since the 1980s. To a fifth grader, this looks like a tall slide at the playground. If you start at the top at $121 and slide all the way down to $74, that is a massive fall. But why did it happen? Was there suddenly no more silver in the world? No. The crime here is a margin hike. The CME Group, which runs the big paper markets, raised the cost to hold a silver contract by 15%. Imagine if your teacher suddenly said you needed twice as many tokens to play a game you were already winning. Many people couldn't afford the extra tokens, so they had to leave the game. They sold their paper silver all at once. This created a waterfall candle, a giant red bar on the chart that looks like water pouring off a cliff. But here is where the math gets interesting. There's a tool called the RSI, which stands for Relative Strength Index. Think of it like a rubber band. If you pull a rubber band too far to the left, it has to snap back. The RSI measures if people have sold too much too fast. For silver, the RSI dropped below 30. In the world of math, anything below 30 is called deeply oversold. It means the rubber band is stretched so far it's about to snap. When the RSI hits these levels, a bounce isn't just a guess, it's a high probability event. That is exactly why we saw that 6% jump back up from the 70s. The math demanded it. Now let's look at the Fibonacci math. This sounds like a big word, but it's just a way to measure a bounce. In nature and in charts, things usually pull back to certain spots before they decide where to go next. The most important number is 61.8%. If we take the big move from where silver started its rally up to the $121 peak, the math says that $86 to $90 is a major battleground. Think of $90 as a ceiling. Silver fell through the floor, hit the $74 trampoline, and now it's jumping back up to hit that $90 ceiling. Until silver can break back above $90 and stay there, the paper market is still in a fight. But for the people watching the physical atoms, this is all just noise. While the paper price was falling 30%, the lines at the local coin shops were getting longer. Why? Because the people stacking real metal know that a digital price drop doesn't change how much silver is in a solar panel or an AI computer chip. The great decoupling is happening right in front of us. On X and Reddit, you see people posting screenshots of their losses. They are focused on the paper, but the elite investors are looking at the volume spikes. When the price hit $74, the buying volume, the amount of people stepping in to buy, exploded.
This tells us that the smart money was waiting at the bottom of the slide with their hands open. They wanted your cheap silver. They used the hype data to scare the paper hands, while they used the oversold math to build their own hoards. You have to understand the difference between a price and value. The price is what you see on the screen. It can be changed by a bank or a computer program in a second. Value is what the metal is actually worth to the world. In 2026, the world needs more silver than it can mine. That is a fact. The charts are showing a temporary reset of the paper system, not a failure of the metal. If you sold at $78 because you were scared, you handed your wealth to someone who understands the RSI rubber band. If you held, or if you added more physical atoms at those levels, you used the math to your advantage. They smashed the price to $71 to see if you would blink. If you didn't blink, you won this round. The window is closing on these lower prices. The physical market is separating from the paper market. We are seeing a two-tiered reality, where the screen says one thing, but the vault says another. Make sure you are on the right side of the fence. Don't let a red candle steal your future. Use the math, stay calm, and keep stacking. Subscribe to Wealth Unwired. We don't do hype, we do evidence. Join the resistance and stay awake in a world of paper lies. Stay vigilant. Investigation closed.